Reinvesting your dividends can make a massive difference to how much money you make in the stock market. Taking a look at these two portfolios on screen, both of which are putting in $100 a month into Coca-Cola over a 30-year period. You can see that when you reinvest your dividends, you'll have $177,000 versus if you don't reinvest, you only have $87,000, giving you a massive difference of $90,000 between these two portfolios. So you can see how much of an impact this strategy can have. Throughout this video, I'll be showing you my favorite dividend yielding stocks, the best way to invest into them, and how to actually retire from the strategy by building a portfolio that yields $100,000 in annual dividends. I always thought that investing was really intimidating, full of complicated jargon and confusing stock graphs, but the purpose of this video is to show you how easy it can actually be to build a passive source of income that gives you financial freedom. No matter how little investing experience you have, anyone can use these strategies and get started with as little as $15 a week. To further demonstrate the power of reinvesting dividends, I'll be using one of my favorite dividend yielding stocks, which is Coca-Cola. I'll be projecting the average growth of its share price, which is 8%, and the average growth of its dividend, which is 3%, across a 25, 30, and 35-year period. And I'll also show you the impact of contributing varying amounts of money to your portfolio and how this can greatly increase your profits. At the moment, Coke is paying out a dividend of 2.9%, and make sure to let me know down below in the comments what your favorite dividend yielding stocks are. I love interacting with my viewers, and I always make sure to respond to all the comments left on my videos. After running through all these examples, I'll be showing you the criteria that you need to keep in mind when selecting which dividend yielding stocks you want to include in your portfolio. So let's firstly look at a one-time investment of $1,000 over a 25-year period into Coca-Cola. So if you reinvest your dividends, you'll have $18,000 at the end of that 25-year period, versus if you don't reinvest, you'll have $6,800. So about an $11,500 difference between the two. If you're reinvesting, you'll have $978 in annual dividends versus $373 if you don't reinvest. So a $600 difference between your average annual dividend payout, depending on which strategy you go with. Now, definitely getting $970 in annual dividends is great, but you can really increase how much money you make from the strategy if you start investing some of your own money into it. Now let's see how much you'd make if you were putting in $25 a week with everything else being the same, a $1,000 initial investment across a 25-year period. So over that 25-year time frame, you'll have put in $31,000 of your own money, but if you're reinvesting your dividends, you'll have $196,000 at the end of it versus $94,000 if you don't reinvest. You'll be getting about $10,000 of annual dividends when reinvesting your income, in comparison to $5,300 if you're not reinvesting. So getting $10,400 in annual dividends is definitely a nice chunk of money, and putting in $25 a week I think is very achievable for most people. You can't start living off this income, but it truly shows you how much your portfolio can grow. Even if you add in no extra money whatsoever, you'll keep gaining profits and your dividend payout will keep increasing. Now, one additional thing that you can invest in and that has a great compounding effect is subscribing to the channel and dropping a like for the YouTube algorithm. Now let's see how much money you would make if you put in $100 a week, and for a longer time horizon, we'll do 30 years instead of 25 years. At this point, you can start actually making enough money from your annual dividend income to start living off. So if you reinvested all of your dividends across that 30-year time period, you would have a portfolio valued at $1.47 million. And without reinvesting dividends, you'll have $533,000. So there's a $940,000 difference between these two strategies. And after 30 years, you'll be getting $94,000 in annual dividend income, in comparison to $34,000 if you're not reinvesting. So a $55,000 difference between the two. Getting a $90,000 annual dividend payout payout is essentially like being on a $90,000 salary, which equates to about $1,700 a week. Now, you can most definitely start living off this, especially when you consider that the average salary in America is $52,000. So you'll be making 60% more than this just from a strategy of putting aside $100 a week. If you start doing this when you're 20 years old, by 50 you can retire and be getting a consistent and passive stream of income of $1,700 a week. Now, this isn't really showing how great this strategy can be. If you really want to ramp things up and start putting in $1,000 a week, it makes a massive difference to how much money you'll be making. So with that extra $1,000 over the 30-year period, with everything else being kept the same, your portfolio will be valued at $3.6 million if you're investing, and if you don't, it'll be $1.3 million. So $2.3 million between the two. And the reason the strategy is so effective is because when you're reinvesting your dividends, you have more money to buy shares, and thus you get a higher dividend payout, and then over time this slowly compounds and grows until you get a snowball effect where the price changes in your portfolio get greater and greater the longer you do it for. So when you start investing larger amounts of money, you can really see how big the gap is between reinvesting and not reinvesting your dividends. So with reinvesting, you'll be getting an annual payout of $222,000, and if you don't reinvest, you'll only be getting $85,000. So a difference of $136,000. And lastly, if you add an extra 5 years, so you'll be doing it across 35 years, putting in $1,000 every month, your portfolio will be valued at a grand total of $7.6 million and only $2.1 million if you're not reinvesting. This means a difference of $5.5 million, and your annual dividend payout for reinvesting will be $535,000 and $151,000 if you don't reinvest those dividends. So a difference of $384,000. Getting $536,000 in annual dividends equals to getting over $10,000 every single week paid out to you from a completely passive source of income. So you can see the power of the strategy and how much money it can really make you in the long run. Now, it's not very glamorous and it does take a bit of time to build up and get to this stage, but it's always important to not get discouraged and be consistent with your investments to see results like this. So taking a look at the criteria that you should be using to pick out your dividend yielding stocks, one of the main things that you should keep in mind is looking at the quality of the business itself. And you can quickly take a look at a company's share price and see how well it's historically been doing. And often what can happen is that people can be lured in by a high dividend, but the share price is consistently falling. So this is called a dividend trap. If you're taking a look at something like AT&T, which gives you a nice juicy dividend of 5.8%, however, over the past 5 years, its share price has gone down 28%. That means if you had invested $10,000 5 years ago, you would have actually lost $2,800. In comparison, Coca-Cola has a lower overall dividend of 2.9%. However, over the past 5 years, its share price has gone up 33%. So there's no point in just buying a company because it gives you a high dividend. You have to actually look at the growth of the business and how stable its share price is. Now, other things that can lead to the stability of the company is how long it's been around for. Coca-Cola was first made public back in 1919, and also its dividend has been paid out and increased consistently over the past 60 years. So you want to make sure that you have a reliable company that always increases its dividend, has a nice stable share price, and the market cap is always something good to look at as well. Larger, well-established blue chip companies, ones that have a value of about $200 billion or more, take a lot more money to drive their share price up or down. So they'll provide you a nice, slow and consistent, again, it's not a fast strategy, but it's a nice stable return so that you know your money is safe. Some other great dividend yielding companies that you could look at are Chevron, which has a average dividend payout of 3.1%, and McDonald's, which has a dividend yield of 2.2%. With all these examples, you can see the power of dividend reinvesting and just having a nice, consistent and reliable strategy when it comes to the stock market. Before I started investing, I thought to get results like this, you had to be an absolute genius and spend hours upon hours researching individual companies and trying to find the perfect one to buy. Always looking at the best buying and selling points, because of course you don't want to miss out on any potential profits, or even worse, lose money on your investment. And in the beginning, I was listening to tons of investing books like The Intelligent Investor by Benjamin Benjamin Graham, The One Up on Wall Street by Peter Lynch, Phil Town's Rule Number 1, and also Principles by Ray Dalio. I was trying to find the secret formula and the fast way to make money in the stock market, but ultimately what it boiled down to was finding a nice reliable company with a good dividend payout that had a consistent growth in its share price and was a well-established leader in its field. I thought that dollar cost averaging into a company like this was too straightforward and quite frankly boring as well, but I just chose to ignore it and always try to find the new hot stock. I was always buying into the hype and trying to find the new best stock. I bought into the meme stocks that were out earlier last year, ultimately with the massive rise and fall of GameStop, and I chose to ignore this tried and true investing advice. And I think a lot of people also fall into that trap where it seems too simple to do something like this and they always try and make a quick buck in the market instead. Now that you're familiar with how powerful dividend reinvesting can be, you might want to check out these common investing mistakes to avoid. These are the mistakes that I made when I first started, and this is the video that I wish I saw when I first started on my investing journey. It would have saved me a ton of money, and I wish someone had told me these tips earlier.